Good morning, everyone, and welcome to our webinar to help explain what is the deal with crypto. It's been a buzzword for years, but what is crypto all about? For those that don't know me, I'm Mark McAllister, Senior Partner for Holborn, based here in Cape Town in sunny South Africa, but broadcasting to our clients all over the world from our multiple offices in multiple jurisdictions. We've been helping clients all over the world to invest their money in the most tax-efficient solutions globally for over 7 years. Please feel free to connect with me on all the social media channels on screen so that you can receive the latest updates on investment trends, tax-efficient solutions, and offerings for the globally minded citizen. There is a section at the end for answering questions, and I've asked that you utilize the Q&A button. It's at the bottom of your screen in the middle to type any questions that you want us to answer, and I'll do my best to answer them all at the end together. Thank you for taking part today. So to understand what cryptocurrency is, we need to first understand the history of money. We started before the 1200s bartering and exchanging goods for other goods of equal value. The problem with that is, how does a farmer who has wheat buy it with something that hasn't even grown yet? You know, what is the rate of exchange of goats for cows? The introduction of coins made from precious metals predominantly created a method of exchange and a key component of what became money that allowed trade to grow across the world. Now, the introduction of new technologies such as telegram, credit cards, and eventually the internet evolved the banking system to a new level where we are all now used to paying with our phones and seeing our monetary balances as a set of numbers on a screen. So the question is crypto the next step in this journey of technological advancement, or simply a distraction designed to steal your hard-earned money? We hope to try and answer that today. Now, while studying the history of money, we also need to understand the evolution of paradigms within the financial system. The first one was an introduction of paper money, which started back, was backed by precious metals such as gold and formalized by the Bretton Woods Agreement. Now, the collapse of Bretton Woods in 1971, also known as the end of the gold standard, has evolved into the fiat system. Dollars, pounds, euros, rands, are all based on trust. We trust the government of the day that they will manage and manage the value of a currency centrally and responsibly, so that our value is defended whilst encouraging growth in an economy of which we are part. Now, with rapidly rising inflation, the question many rightly asked themselves in the last few years is, can we rely on central banks to protect our wealth? This graph shows you that $1 of purchasing power in 2020 would have been equivalent to $26, over 100 years ago. And obviously, this didn't happen overnight, but over time, you will find that your cash buys less and less and less every single year. Over 25% of dollars in circulation have been printed in the last few years, and as a result of quantitative easing used by central banks to support the economy through these recent troubled times, we're now seeing 8+% inflation in developed nations. Sorry, I do apologize. I think we've got a technical issue here. So if you keep all of your long-term investments in cash, you are only effectively losing purchasing power every year to an effective stealth tax. So it's essential to protect your wealth through effective and suitably risk-profiled investment strategy. So on the subject of monetary trust, we have to ask ourselves and step back and say, why do we trust or distrust anything? Is it because we are told to, and who by? Perhaps it's by friends and family, or these days via social media. In the old days, this wasn't the case. We'd often listen to a centralized source, such as a newspaper for news or a travel agent for where to go on holiday. These days, they have been replaced by the likes of Facebook and TripAdvisor as the source of many of the decisions that we all make every single day. So already we now have plenty of examples where we now have decentralized systems of trust over centralized ones. Digital assets such as Bitcoin are examples of a permissionless and decentralized approach to finance and banking. Sometimes that might seem odd, but now we could be heading towards a new paradigm in finance. Bitcoin is without a doubt the most established and well-known of all cryptocurrencies or digital assets. So I work in finance every day. This includes moving large amounts of money around the world to protect wealth from geopolitical risks. Depreciation of the rand in South Africa is quite a common thing that people are looking to protect themselves from. And when people ask me, what does Bitcoin actually do? The most significant thing it allows you to do is to move money instantly without permission anywhere in the world. Now, this may not seem like a huge need on your agenda if you're in a country that works very well, but as an ordinary Russian citizen found out early this year, some were left with rubles they couldn't do anything with globally, and as a result, many of them turned to crypto as an alternative. This same event has happened in countries like Venezuela, Argentina, Turkey, and Zimbabwe, all with high rates of inflation. So the message is that when nation states fail their citizens, it's quite often they start to look at crypto as a solution. Now, Bitcoin is the oldest and best known example of cryptocurrency. It's what created as a result of a white paper by somebody called Satoshi Nakamoto in 2008. One thing people find strange is no one knows who Satoshi Nakamoto is. Now, my personal belief is that he may have been a guy called Hal Finney. He created the pseudonym based on his neighbor, a guy called Dorian S. Nakamoto, who lost his house as part of the global financial crisis. Hal was deeply troubled by this and wanted to use his cryptography skills to create a new form of digital peer-to-peer cash that didn't rely on banks. There's only ever going to be a maximum of 21 million Bitcoins currently. There are 18.95, so about 19 million in circulation. You don't know, so you don't have to own a whole Bitcoin. It can easily be broken down into smaller units called Satoshis. And Satoshis are kind of like pennies that make up a dollar. However, there are 100 million Satoshis for every Bitcoin. So it can be subdivided pretty easily if required. Bitcoin is an example of a currency on a blockchain, simply new technology solving old problems. Now, a blockchain is a decentralized and distributed digital ledger that is used to record transactions across many computers so that the record cannot be altered, changed retroactively without the alteration of all the subsequent blocks and the collusion of the network. So in the current banking system, we have to have trust in a bank to hold the central ledger. And now what we're seeing is systems where the ledger is replicated across multiple nodes on the internet run by miners who are effectively like auditors who keep the network alive and are rewarded in Bitcoin. 6.25 Bitcoin is available every 10 minutes as a reward to miners until the next halving event, where the reward will drop to about 3 and so on and so forth. Every 10 minutes, the ledger is verified by at least half of the network, so at least 51%, and it is then stamped and added as a new block on an uneditable chain of other blocks, hence the expression blockchain. The network has not missed a beat since its inception, and unlike traditional banking systems, there are no branches, there are no staff really. It's a very effective form of what we call DeFi, which stands for decentralized finance. Bitcoin is also digitally scarce, a concept which is hard for many to wrap their minds around. You can prove you own something digitally, using a blockchain that can't be copied and pasted. This is done publicly and visibly on the blockchain. What isn't visible, though, is who owns what wallet. You can therefore see what each wallet has as a balance, but unless you know who the owner of that wallet is, it's still very anonymous. One other question we often hear is, can it be hacked? In a short answer, no. It can't be, as it would involve taking over 51% of the network and subverting that public ledger within that 10-minute window, something that really isn't feasible with current technologies. That being said, like the banking system, there are weaknesses which criminals will try and exploit. No different to a bank robber walking into a physical bank and stealing money out of a cash register, your email address and thus your wallet could be hacked, or the exchange that is hosting your coins could fail, such as MTGOX or Cryptopia, but more on security later on. The most common question I get, though, is why does Bitcoin or any other digital asset have a dollar value? And to answer that question, we need to consider both sides of the argument to explain what the value may be driven by. So the bull or case for Bitcoin is advocated in this example by Michael Saylor, CEO of MicroStrategy, who are now one of the largest institutional holders of Bitcoin globally. But we should start with the case against Bitcoin's dollar value. And this is advocated by Peter Schiff, who has famously said it's going to zero most weeks for a number of years. Who is right or wrong? Only you can decide based on your point of view. So Peter is in the corner for the naysayers. He believes that what we are seeing is akin to the 1636 tulip mania, which saw huge price appreciation for something that was effectively worthless. Other examples include the South Sea Trading Company, which almost destroyed global faith in the new stock market system. Famously, the UK banned the trading of shares until 1825 as a result. And if Bitcoin is a bubble, then it will most likely follow the typical bubble parabolic price action before it collapses. And Dr. Jean-Paul Rodriguez came up with an example of what a bubble price action graph might look like. These kind of rapid price appreciations are normally driven by a fear of missing out, or FOMO, something that can be seen in everything from the tulips example to Beanie Babies. And we call this greater fool theory. The idea being that you can sell something of little or no value onto someone that is a greater fool than you. It's kind of like a game of musical chairs. You don't want to be left holding the bag when the music stops. So with the sound of alarm bells in our ears, we need to review Bitcoin's price action over the last 13 years. There is no doubt that it has seen significant appreciation in value from a few pence up to a peak of nearly $70,000 in October 2021. It's since then corrected downward significantly and are now at a value of around $30,000 as you listen today. So with it now down 50% from its most recent peak, has the bubble popped? And is it all over for Bitcoin? We certainly are seeing significant fear in the market that prices could go much, much lower. But as we look at these steep price declines, the obvious question is, has this happened before? And the answer is actually yes. So let's have a look at just one of those examples. So in this graph, you can see the value of one Bitcoin rocketing to a huge value. Is it the $69,000 peak in 2021, you may ask? Actually, no, it's not. This was the bubble in the price in 2013, so nearly 10 years ago, where it rose up from $135 from only 4 cents before collapsing back down again. So let's try and find that on a long-term chart. Here you can see it's a tiny blip on the longer-term price action before it resumed its appreciation. So to be clear, Peter Schiff and the naysayers are saying that Bitcoin is a bubble and the price will go to zero. And if greater fool theory plays out, they will be proven right. And there is a high chance of that. So perhaps what we are seeing, if it's not that, is, perhaps what we're seeing is a number of bubbles connected end to end, and it's actually a massive bubble that simply hasn't come to an end yet. Now, one must not ignore this scenario, and again, it underlines why Bitcoin and other digital assets must be seen as highly volatile and risky assets, and nothing other than money you are prepared to lose should be exposed to it. But if it's lots of bubbles end to end, perhaps it might not completely collapse as Peter predicts. The question is, what else can explain this price movement over time? And this is where we bring in our case for the Bitcoin bulls. And in this corner, the red corner, I present the CEO of MicroStrategy again, Michael Saylor. One of the reasons why we may struggle with the understanding of is this a bubble or something else is the time frame. So crypto feels like it's on fast forward sometimes. You know, typical stock exchange is open for about 2,000 minutes a week, but Bitcoin effectively trades 24 hours a day. So if we translate it into the same sort of time frames, it's been around for effectively about 58 years. And so therefore, this would make it the longest bubble in history. Michael will have you believe that Bitcoin is the best thing since sliced breads, so much so that he's actually issued corporate bonds and used the debt to buy more and more Bitcoin from MicroStrategy. What he mentions in this quote is very important point, and that's about the network itself. You know, if, and I have to underline, if it's not greater fool theory, perhaps another theory could explain its price action, and that is network theory or adoption theory of that new technology, that new network. So if we look through history, technology is adopted at faster and faster rates. When the telephone was invented, it had little value as a network, as Alexander Graham Bell called his colleague, probably sat in the next room. Now look at all of us. You know, we've all got phones by our side. You know, you might even be watching us online through your phone today. How much is that network worth if you could buy a piece of it? Facebook is probably the most recent example. You know, when Mark Zuckerberg came up with the concept in his dormitory in Harvard, it had zero value. And when it listed in 2012, it was worth 100 billion. It's worth a heck of a lot more than that now. So where did that value come from? Many would argue its value rose in line with its network of users. So network adoption theory says that Bitcoin is valuable because you can effectively own part of a network. And due to its fixed supply, as demand goes up, so will the price, similar to other technologies that have been adopted over the years. That being said, again, I have to underline that as a company, we see this as a dangerous view, and we believe it's a speculative bubble that will more than likely fail. The price of high-risk assets like crypto, though, appear to also be influenced significantly by market sentiment. To explain what this means, I'm going to use a sporting example. Now, I've had this image in the presentation for a few years, so I appreciate it's out of date, but it shows the England rugby team's previous peak in 2003 when we won the World Cup. Won the World Cup, and what a beautiful time that was. Seems like a distant memory. Our team's performance, did decline through 2007, and it could be argued that we hit rock bottom in 2015 when we got knocked out in the group stages. So at this stage, would I have swapped my England jersey for a Springbok one? Absolutely not. And the performance, improved significantly after that. And though we didn't win the World Cup in 2019, as my South African friends and colleagues like to remind me on only too much of a regular occurrence, we were still at a higher point in 2019 and beyond than we were really in 2015. So the same could be applied to the world of investments, not just crypto. There are two emotions that drive human beings when it comes to investments. And when it comes to making investments, making decisions based on either fear to sell or greed to buy can go badly wrong. One way to make money with investments is to try and buy low and sell higher. And we call that in the industry timing the market. The problem is that the best time to buy is normally when there is blood on the streets, or as Warren Buffett would say, be greedy when others are fearful, or be fearful when others are greedy. What this means is that fear will make people feel it's time to sell their England shirts or investments, in this case, at the point of capitulation at the bottom of that graph. And in doing so, miss out on the move back up towards the euphoric high of a Rugby World Cup final, or a market high in this case, a few years later. When there is a euphoric high in a market, it's often described as a greedy time or a period of maximum financial risk, or FOMO, fear of missing out. And if you are timing a market, that's probably the time when you should consider selling whatever it is that you have. But what if the price just continues to keep going up? Therein lies the conundrum. So one way to mitigate this is to buy and simply forget about it. And instead of having time, instead of timing the market, have time in the market, or as those in the crypto community like to say, hodling, which stands for holding on for dear life, and that's an entirely different discussion in its entirety. Warren Buffett says it in a different way. He says his favorite holding period is forever. Long-term wealth transfer is the transfer of wealth from the impatient to the patient. If you're not sure whether, where you are in a market cycle, whether it's in property, stocks, or even crypto, it's best to talk through it with a professional financial advisor like the team at Holborn before acting on any emotion, be that fear or greed. You may find that buying high and selling low is what ends up happening, and this can result in financial ruin in the long term. So to be clear again, we're not advocating this as an investment strategy. There is no get-rich-quick options here, but if you are considering any allocation to a high-growth risk asset like new technologies, it's something that you should talk through with your professional financial planner as part of a holistic overview before you do anything at all. As everyone is different, there is no one-size-fits-all. Our message is, do your own research before taking the plunge on anything. Okay, so if you've listened this far, you may have decided to consider, that you want to buy cryptocurrency. The question is, how? So let me provide you some factual information that's publicly available as to your options and the risks associated with them. So the first most obvious route is to buy cryptocurrency via a recognized exchange, and preferably one that's also registered with the financial regulator in your country of residence. That's if they obviously do regulate cryptocurrency, and a lot of countries aren't quite there yet. There are lots of them globally. There's some examples on the right-hand side, and they will allow you to exchange your dollars, your euros, your rands or pounds for Bitcoin and other digital assets. Once you have purchased that crypto, it will sit in a wallet on that exchange until you move it somewhere else. If you have an investment platform account or a tax-efficient global investment structure like a lot of our clients, one option is to acquire units in an exchange-traded fund or an exchange-traded product that have exposure to some form of digital asset or cryptocurrency. These behave in a similar manner to any unitized fund or ETF. Finally, you may be encouraged to give your money to a pro trader or join a cloud mining group or pool, or have some kind of referral program that will pay you bonuses as you encourage people to join your crypto friends network. Look, I've highlighted this in red because they're nearly all scams and should be avoided like the plague. So how do you avoid being scammed? Well, like any gold rush, such as California in the 1800s, many will come from all over the world to seek their fortune. And around the peripheries of these discoveries, you'll find those that are selling pickaxes and shovels, but also you will always find those who will try and cheat and lie and steal away your gold that you found along the way. And in crypto, it's no different. There are similar examples of scammers that you need to be wary of. Here's just some examples over the years, all of which have showed clear warning signs that they were Ponzi schemes. The principle of a Ponzi is to look to find sucker investors and sucker them into something that will fail. And the principles are identical to when Charles Ponzi created them in the 1920s. It's just a hook that's different these days. Remember that the transfer of wealth goes from the impatient to the patient. There are no silver bullets. Excuse me. So clear warning signs of scams are things like, something that sounds too good to be true. It normally is. Anything that's advertised and promoted on social media platforms, particularly if they name celebrities as a hook. Any form of guaranteed returns, it's very, very unlikely that guaranteed returns will actually materialize. Any form of bonuses or referral commissions for encouraging others to invest is another red flag. Some kind of special algorithm or an idea, but it's hidden behind a metaphorical curtain of old, black box of trickery. Again, another big red flag. And finally, high pressure sales tactics. So the pressure to sign up now, there's a one-time offer, do it now before you lose the opportunity. Again, all of those are signs that you may be suckered into the next Ponzi scheme. One of the biggest examples of this in recent years was Mirror Trading International, which impacted a huge number of investors all over the world, but in particular here in South Africa. Nearly all of those red flags were highlighted in the previous slide, were present in this scam, and the local South African regulator, the FSCA, were actively warning investors all the way through 2020 before its collapse in December 2020. Okay, so if you've already acquired some digital assets that you wish to keep, we would recommend that you store them on a digital hard wallet. Something like a Trezor is a good example, similar, but bear in mind how important it is to record your private keys in a way to protect them from hacking or theft. If your coins or tokens are stored on an exchange, you also have what we call a counterparty risk if that exchange fails with very little recourse. This is underlined when NT-GOX failed in 2014 and Cryptopia in 2019. So remember, not your keys, not your coins. Stable coins are also now a high-risk item or high-risk option. This is highlighted only in the last week or so with the collapse of USC and the Luna token, which I'll talk a little bit about in due course. Data analytics firm Chain Analysis estimates that about a fifth of all Bitcoins that have been mined to date, somewhere between 2.78 and nearly 3.8 million, are lost. And so be aware of this risk. If you choose to buy any cryptocurrency and don't store it properly, this is quite a daunting thing to consider. Okay, I'm going to finish up by delving into some of the thousands of alternative cryptocurrencies, and Ethereum being the poster child for them. Ethereum is more accurately described as a digital smart contract software, which is tokenized. It allows programmers to create other tokens or smart contracts, everything from artworks to songs, creating automatic token royalties and the like. It's also the most prevalent software that is being used to create ICOs, initial coin offerings, and NFTs, non-fungible tokens, which is the buzzword at the moment. Non-fungible tokens or NFTs allow you to own something that's digitally unique and prove your ownership to the whole world on a blockchain. Let's take an example of a famous painting, let's say an Andy Warhol. Some people see huge value in buying an Andy Warhol, and a recent Marilyn Monroe example sold for 170 million US dollars. Who would know that you own such a piece? Well, obviously any one of your friends that came over to your mansion, I assume, and saw it above the fireplace, and that has a certain, you can call it a flex value to high net worth individuals to own something that others don't. But unless you promote your ownership, unless it's in a magazine or in social media, not many people will know that you're the owner, which might be fine. That might be what you're looking for. But if someone takes a photo of it above the mantelpiece, they don't now own it. You do. And an art expert will have to have verified that it was an original Warhol, and that would, in theory, have been done before you purchased it. Now, with an NFT, anyone can see you own that unique digital artwork or similar instantly on the blockchain. And this has then morphed into a range of digital collectibles, from crypto kitties, punks, and bored apes. You can, in theory, flex to the world the things that you have collected along the way. And again, we have to underline that these are highly speculative, and the vast majority are likely to become worthless. Take the example of the guy who bought an NFT of Jack Dorsey's first tweet on Twitter for $2 million. It was recently offered only a few $100s at resale. So tread carefully. Again, we do not recommend any of these types of assets as investments. So in summary, our company view on crypto and digital assets are that they are speculative assets that are highly risky, volatile, and could potentially go to zero. You could therefore lose everything that is exposed to crypto, and it's essential that you do your research before jumping in, and only with money that you're absolutely prepared to lose. There are no get-rich-quick schemes, and be very mindful of the scams that exist in this space. I hope that was an enjoyable and worthwhile webinar. If you haven't already done so, we're going to move on to our Q&A session. So please do ask a question at the bottom. There's a Q&A button, and I'll do my best to answer them for you now. If you'd like to know more about anything that we have discussed today, or have any further questions, then don't hesitate to reach out to me directly, or just follow us on the socials detailed on screen now. Okay, moving on to our questions then. Yeah, so thank you very much. Just got some messages coming through there. Thank you. Yes, try to do our best to give a balanced overview of this latest technology. Question here from an anonymous attendee: what is our take on the Pi network? So at this time, all that we can say is that any network, anything that is using something like Ethereum to create an ICO, is very much at the high risk end of a high risk asset class. I think this was underlined recently when you look at Luna. Okay, everything sounds great in these white papers when they're launched, but unfortunately they can and do fail, and when they do so, dollar value can follow or can fall significantly. Just being asked there what happened to Luna. I don't want to get into it too much. It's available in the public domain, but effectively what appears to have happened is that they have a stable coin called USC, and a large amount of that was sold very quickly, and in doing so it started to create a run on the currency. The idea behind Luna and its stable coin was that they would sell Bitcoin to effectively prop up the peg of the price, and unfortunately both started to cascade down very, very quickly, and effectively it was like an old school run on a bank, but in a cryptocurrency world. Moving on then, what's the maximum amount as a percentage of a tax efficient structure that I'm allowed to hold through crypto ETFs, mutual funds, etc., with a crypto exposure? Again, I can't really answer that. It's on a case-by-case basis, so you're going to need to sit down with your financial advisor, if you've got a tax efficient structure, and talk through what assets are in it. What you'll find is that a lot of the platforms that you use, rightly so, put limitations on the ownership of any form of digital assets. So, a cryptocurrency ETF or ETP probably wouldn't be allowed for a number of very, very good reasons. So yeah, probably best to have a discussion on a case-by-case basis. Where can one find a list of wallets that is good? Again, the only advice that we can offer there really, it's is hardware wallets. That's one of the things that we need to think about as a way of protecting if you have exposure to it. Okay. What is my opinion on a new and upcoming coin? Yeah, again, we can't really provide an opinion on it more than that they are very speculative. I think you can maybe draw a parallel to the early .com bubble sort of situation. Most ICOs, most initial coins, most of the NFTs will be worthless. There may potentially be some that have a higher value than they do now in dollar terms, but again, that's very, very speculative. We wouldn't be able to comment on that. What is a hardware wallet? That's a great question. So when you buy cryptocurrency, it will sit in a wallet on an exchange. So if we take something like Coinbase, it's a very well utilized provider in the US. Okay, you have a wallet on there, and that will have an address. A hardware wallet is a wallet that is outside of an exchange system, so it sits on the public ledger. And to move crypto out, so let's say Bitcoin, out of a hardware wallet, you have to use a little key, a little physical fob. So it's very similar. I'm not sure if you recall the sort of fobs that you would have for your online banking back in the day that spews out a load of numbers. So without that little fob, it makes it virtually impossible to move crypto around, and that can stop you from being hacked. So hardware wallets is something that's worth looking into. I appreciate there's a lot of questions coming through on the chat. I'd like it, if possible, if you could ask them on the Q&A, just because it's easier for me to manage from this side. Okay, great question. Now I'll try and answer both of them together. Are there any crypto ETFs, and are there any ETFs available in South Africa? Okay, so again, I'll try and do this without stepping into what might deem to be advice. So this is factual. You can Google it yourself to verify it. Okay, so there are a number of crypto ETPs, exchange traded products around the world. They're in places like Switzerland, they are in Canada, they are in, I think I said Sweden, Switzerland, kind of the main ones. And they are what we would call a synthetic derivative. So they normally follow the price action, through some kind of mechanism. So you don't actually own cryptocurrency. You own a unit of a fund that is exposed to the movement of cryptocurrency. So those can be held on platforms. Okay, so you might have an existing platform where those can be purchased. But what you'll find quite often is that most platforms have restrictions. For example, the FCA in the UK have banned the use of exchange traded products in virtually all platforms that domicile in the UK, and it's a very prudent choice at the moment, whilst it's a very unknown technology that's quite speculative. Okay, as far as are there ETFs? Yes, we are now seeing a new range of ETFs that have physical Bitcoin in them, but normally through futures contracts. Okay, so the final sort of hurdle, as it were, is a physical Bitcoin spot ETF where it owns Bitcoin under the hood, as it were. And there's been really all eyes are on America. So the SEC have rejected multiple times applications to create the first Bitcoin ETF in America. I think all eyes are now on Grayscale. So Grayscale Trust is one of the largest institutional holders of Bitcoin in the world, and they have made an application to create an ETF. Okay, and then we'll wait and see whether the SEC rejects that one as well. Okay, hopefully that answers your question. How do you obtain a hardware wallet? Again, we don't really stray too far into this. You can find information within the public domain from the likes of Trezor, what have you. One little safety tip that I would recommend, though, is that when they ship it to you, to normally buy from an online store, or you go to a physical shop that sells these. Make sure that the seals, the security seals, are intact, because if not, what you might do is have a hardware wallet that's actually been compromised during shipping. They seem to have cured that issue, but it was something that was identified a few years ago as a bit of a risk. Okay, just going through a couple of the other questions. Bitcoin is treated as a high-risk asset in the world of traditional finance. Could it be argued that, in fact, traditional finance is currently high risk, taking into consideration rising inflation? Thank you, Steve, for that question. Yeah, I think I've made our company position very clear. You know, the evolution of the financial systems over a number of years has taken a long time. You know, we've seen numbers of checks and balances going into that system, particularly after things like 2008. So, look, at the end of the day, can't really say anything more than that. I think I made a pretty fair and reasoned argument for both sides of the argument, for and the against. Okay, so I've been asked 3 times to expand on the USDC issue. I'll try my best on that. So a stable coin is effectively a tokenized version of a dollar. The idea of a stable coin is that you can effectively swap out of a cryptocurrency into a digital dollar. Okay, these are not regulated. Okay, so it's not protected in any way, shape, or form. And I will share the disclaimer again in a minute just to underline the risks associated with it. So you may think that you've got dollars sat on a crypto wallet, but actually it's a token that represents a digital dollar of value. If that digital dollar fails, so for example, with the USDC issue as an example, the mechanism behind it appears to have failed, and you know, still a lot to come out in the wash as to who was behind making it fail. But then it means that effectively all of those digital dollars are gone. And it's one of the things that, you know, we may see central banks starting to come into. There's already been discussion about things called central bank digital currencies. You know, we may see those at some point in the future, but again, that's me just sort of speculating what the future might hold. So hopefully that gives you as much as I can say really at this time in a public forum on as to how that's come about. Okay, we're going to take another couple of questions just to sort of wrap things up. What do I think of the security of Kraken? Again, you know, all I can say is the same that I've said for all of the exchanges. You know, anything that you have on a public exchange like Kraken, you know, like Coinbase, Binance, any of the others that you could easily Google on this, you know, you do have a counterparty risk with that exchange. So the message again is not your keys, not your coin. So have a think about how you would securitize that in the methods that we've described. Okay, last question here. Would you advocate people to independently consider holding a percentage of their, I think assume that's wealth? And what is the strategy for investing in crypto, e.g. scaling out, scaling in? Again, I'm sorry, Kate, thank you for the great question. You know, unfortunately, I can't provide, you know, a view on that. It's just not possible for us to do so. You know, as a regulated financial services business in multiple jurisdictions, all that we can do at this moment in time is say that crypto exists. It's an asset that we're aware of. You know, we want to educate our potential clients and our existing clients so that they don't fall prey to scams. We think that's a prudent thing to do. But, you know, it's a very volatile asset class. And if, you know, our view is the sort of Peter Schiff view that this will probably be a speculative bubble that will collapse, you know, therefore, you know, no investment strategy is something that we can recommend. As far as what clients want to do themselves on an execution only basis, that can only be made as a decision by them, you know, and that's something that they would do themselves on whatever platforms that they have, and we can't comment on that. Okay, so I think that's it for the Q&A, unless there's anything else. Last one here actually from Chris. I have a CFX account. What would you say problem. Again, unfortunately, Chris, I've just got to refer back to my previous answer on any form of exchanges. If it's not held on a wallet, whether that's physical or away from an exchange, then you do have that counterparty risk. Okay, ladies and gentlemen, hopefully that's been useful as an introduction to cryptocurrency and what it is and potentially what the future may hold, and some tips around safety, security, and risk. Again, just want to re-underline that it's not something that we would recommend. No guarantees are offered by our business in relation to this. This is a factual presentation of information. It's not investment advice. Thank you very much for attending, and do tune in for the next one where we might be expanding on this further in future webinars. Thank you and take care.